Are you worried about turmoil on the markets? This video puts investing into context so you can decide what you do with your money so that you're not spooked by turmoil on the markets. If you're new to this channel, then please consider subscribing, and pressing the like button really helps me. So before we talk about turmoil, I've just got to do a little disclaimer that this isn't investment advice. It's intended to give you some context so that you can make decisions. I can only advise if I've got you and your hopes and your dreams and your finances in front of me, and we can have a two-way conversation. When we look at different classes of investments, I've done a separate video which is called Investing in an Uncertain World, and that's in the investment section on the playlist on the YouTube channel, so you might want to have a look at that later. So what to do if the markets gyrate? Well, the first thing is don't panic, because what panicking means is you tend to sell when things have sold off and they're reduced in value, and then buy when things have recovered and they're high in value. That's exactly the opposite of what a successful trading strategy would be, because what you want to do is buy when they're low and sell when they're high. So sometimes when there are gyrations, there's an opportunity to buy, but it's really important not to panic in the first instance. And the way that you don't panic is by having a clear strategy and understanding the risks that you're taking, so then you don't get spooked. When I look at the economy as a whole, we do have to remember that there's more debt in the economy than there's ever been, both in gross terms, the total value of it, and as a percentage. The levels of debt are huge. And it's also worth remembering that money is debt. So when you have money in the bank, they don't really have that money. They don't have that cash behind the till. It's a debt that's owed by the bank to you. And even notes and coins are debt that's owed by the Bank of England to you. So all money is debt in our system. And there is more debt than there's ever been before. So how can that be cleared? Well, the way that the market wants to clear that is by having a deflation. And in a deflation, what happens is there's insolvencies, banks might go bust, there's unemployment, prices go down, and it's a hard time, and it's not something that anybody wants to particularly live through. And the powers that be are very, very keen to avoid a deflation, and they certainly don't want something like the Great Depression, and neither do I. So what the authorities do when they saw, for example, in 2008, that the economy was deflating down, they pumped it up. So they pumped it up and reflated and inflated the economy to stop deflation from happening. But of course, the result of that, it has been peculiar. So effectively, they've got rid of a debt crisis by creating more debt. And obviously that's not a long-term solution. They've also made distorted interest rates. Now I can prove how distorted interest rates are, because government issues debt, bonds or gilts they're called. And they can issue these debts for 20, 30, even 50 years sometimes. But let's take the 30 years. And some of those are index linked. So they give you your money back plus inflation after 30 years. So what that does, it's really good for a geeky person like me. What it does, it brings together interest rates and inflationary expectations all in one place. So you can see what the market expects inflation to be and interest rates. Now this is important. So this is the punchline. If you've got a 30-year index-linked bond, then the markets expect you to lose a negative interest rate of 2% every year. So every year for the next 30 years, you'll lose 2%. So over that 30 years, you'll lend the money now and you'll get something like half of it back in 30 years' time. I mean, that is so distorted, and no two individuals would enter into an arrangement of that nature. And I think it's a really good illustration of just how broken the markets are. And they're broken because they're being distorted by the government trying to ensure that we don't have a deflationary bust. Of course, by guaranteeing that we don't have a deflationary bust and distorting interest rates, how can a millennial retire for their pension? So if they invest money, if they invest £1,000 for their pension now, by the time they retire, it's going to be worth half, less than half of what it is now. And that makes retiring for them really, really difficult. And that's one of the implications of the distortions that are going on. But so what? Does that matter? Well, we've got these distortions in the debt. We've also, partly as a result of pumping up the market, we've got record stock markets. So back in January 2020, the stock markets were at a record high, and by any definition, they were overvalued or very highly valued. Overvalued is pejorative, but certainly very highly valued. So what's the position now? Because they sold off in February time. Well, they're even higher. So despite all the problems that we've had over the last 6 months, the stock market as a whole thinks that companies are worth more now than they were back in January. But again, does this matter? Well, I think in terms of the stock markets, what's likely to happen is if they start crashing and they start deflating, then the powers that be are going to do whatever it takes to get them back moving. And they have actually been largely successful. So in 2008, although we had a nasty recession, it wasn't awful. There wasn't mass unemployment. There wasn't a deflationary crisis. There were some of the banks went bankrupt, but there wasn't a whole scale bankruptcies of the financial system, which there would have been if they hadn't intervened. And it is possible that they'll be able to kick the can down the road again and again and again. I think they won't be able to forever, but it might be 30 years before it all unravels. And I might not even be alive then. And there's no point in being smug in the graveyard. So I think we've got to be cautious in our approach. But I think that these huge forces, so you've got the debt and the deleveraging of the debt that wants to deflate the economy, and then you've got the authorities trying to inflate it. And at some stage, they might press that inflation button too hard and we get tear away inflation. And I don't know if that's going to be the case because I can't control what they do, but it could happen. But when you've got these great big forces that are acting together, what you get is these huge and unstable markets. And that's why we can see big gyrations in the market from time to time. So I believe that it is possible that we will have a deflation because the authorities will no longer be able to control the deflationary forces. I also think it's possible that they'll overreact and we'll get inflation. If I was going to put money on it, I would say that we're likely to have some deflationary event and then an inflation because they've overreacted, one followed by the other. But I cannot predict the future and I can't predict what other people are going to do. So I need to protect myself. And I would suggest that you need to protect yourself in such a way that you feel comfortable with the risks that you're taking. So again, the first thing to do is be comfortable with your risks. And the first thing to do, and the most important thing to do, is not panic and overreact yourself. I mean, I'm accusing here the government of maybe overreacting. You don't want to copy them and overreact. Decide what you're going to do and keep to it with some flexibility. But I think that's the best strategy. So let's have a look at the different asset classes. So I've already talked about how I think that the bond market is showing things that no two people would transact together in that way because negative interest rates sort of defy logic. So personally, I wouldn't invest in the government bond market and the associated company debt markets. But what do I know? In a deflationary event, interest rates could go much further lower. And they might be really good things to do because there is a safety. Even if you're going to make a loss in over 30 years, at least you know exactly what the loss is. And there is value in the knowledge of what's going on. But for me, I think they're too broken for me to invest in. But, you know, each to their own. Cash is important because in a deflationary world, then cash becomes king because assets become less valuable and you can pick up a bargain. And also, you just need cash to do your daily business and make sure you're not one of the people who is made insolvent. So having some cash is important. But I have two caveats on that. One is that with inflation, even over the last years, let alone what's going to happen in the future, with inflation, cash tends to be a poor long-term store of value. So be careful. In the long term, cash loses its value, but in the short term, it might be really useful. The other side of it is, if you've got more than £85,000 in any bank, then they might take that money. So if an insolvency event happens and your bank is insolvent, then anything more than 85,000 is at risk, and you might be one of the people that suffers from that insolvency. So be careful if you've got too much money in your bank account. I know to some extent having more than £85,000 in a bank account is a bit of a first world problem, but all investments are a first world problem in a way. So shares, I've invested in shares in the past. I've invested in shares often and frequently. At the moment, I just think, personally, I think they're really highly valued. I actually think that if the market starts to crash, then what's more likely to happen is that the government will pile in, and one way or another, the markets will get back because of the money coming from the central banks. But I can't determine what the central banks are going to do, so that makes me feel nervous. But as part of a balanced portfolio, they do sit comfortably in there, just not for me, but I can see why people would invest in shares, because they are sort of a passive way. All you have to do is buy the shares and then they'll give you a return. Whereas if you do other things like invest in property, then you've actually got to work at it. So I think as part of a strategy, they can be useful. But you need to understand the risks, and I think it's particularly important to understand the risks in shares. So you have to be in there for the long term, because you have to be able to not panic when the markets sell off. People who know me will know that I like property. I like property because it's real. I think there's bad things about property, so I think it's quite expensive at the moment, so it could go down in value. And in a deflationary world, it definitely would go down in value. And in a deflationary world, we've got to be really careful about mortgages. So I don't like having high mortgages, because the risk in a deflationary world, maybe you don't get your tenants in, maybe tenants don't pay, maybe they'll pay less, maybe the capital value of your property reduces so you can't remortgage. All of those things can happen. So in a deflationary world, you have to be careful. So I don't like too much debt, but that does mean that I can't take full advantage of the potential gains. But personally, that's good for me. And I think that the risk that you're willing to take depends on your age and just how much risk you like, and perhaps your other income and other assets. Gold and silver, I do talk from time to time about gold and silver. I think that as an insurance policy, having some gold or silver is a good idea. I have some in my pension scheme, which is all nicely vaulted by people, so that it's all secure. It's just a small amount. So if it all does go wrong, and we have to start again, and at least I've got something. It doesn't give you a yield. It just sits there, but as a store of value, it has been good. The problem with it is that at the moment, because of everything that's going on in the markets, then it is very expensive. So again, everything that's good is expensive, but I think that's just the way the world is at the moment. So maybe, but just don't go all in on gold, or you choose your own risk. But if you go all in on that, then be careful. I think an important asset class that we mustn't forget is small businesses. So having and owning a small business and operating a small business is a really good way of getting security for your family, and to secure your income in the future. And I think investing and being careful with your small business and making sure that it prospers is actually a really important part of any investment strategy for business owners. So I've rattled through the main investments and why I think the markets might gyrate, and why I think the most important thing is not to panic and to make sure you're happy with the risks that you've got. Because I think if you're happy with the risks that you've got, and you've taken long-term views and you've thought about it, then you're not worried. You don't get worried about gyrations in the market. And I think not worrying about gyrations in the market is sort of part of the solution, because at the end of the day, it is just money, and it's people that matter, not money. So we always need to bear that in mind. So I hope you've enjoyed this video. I've rattled through it. If you want to discuss anything in the video, then you know where I am. And if you want to comment, then I'll be interested in your public views. They're always interesting. And if you are new to the channel, then please consider subscribing. And if you press the like button, it does help me. Thank you.